Hi, I'm Kathy Hagan, business consultant with the Florida Small Business Development Center Network. To access capital, banks and investors really are interested in seeing your business plan, demonstrating how you're going to make money, how you're going to repay a loan and or provide a return on investment. And so they're going to look to your business plan to be able to communicate that message. They look at the narrative portion of the plan, talks about the description of the business, the market, the marketing strategy, the management team. All of those things are very important, but ultimately they're going to want to see the numbers. They want to see how much money you need, what are you going to do with it, and how are you going to pay it back. So let's talk about the financial data that's included in the business plan. So the first piece of financial information that you want to provide for a lender are the sources and uses of funds. Requires that you have a good sense of how much money you need to borrow, how much the total project cost is for getting your business started. So sources of funds, looking at where that money is going to come from, some of it from your own pocket, or somebody else's pocket, some of it perhaps from a loan. So total amount that you need in order to fund the startup and running of your business. Okay, and then we want to document what you're going to use that money for. Is it to purchase building? Is it to purchase equipment? Initial inventory, other startup costs that you might run across. So I have a good laundry list of what it's actually going to cost me to open the doors. And so total uses of funds is going to equal to the total sources of funds. So I've communicated that I know how much I need to get this business off the ground. The next important financial statement that's included in the business plan is a profit and loss statement or income statement. These are projections looking into the future. If I have an existing business, I would also show my historical financials, but we're really talking about projecting into the future what's going to happen within my business, based on the market research that I've done, based on the product development, those types of things. So a profit and loss statement looks at sales, how many dollars you're going to bring in terms of sales revenue, collection from customers. And I'm going to develop that number based on market research that helps me determine number of customers. I'll marry that with the pricing of the products or services that I sell and have a total sales dollar that I'm going to collect. I have cost of goods, raw materials, inventory, things like that, and which would then give me a gross profit. And then I have operating expenses, fixed expenses that are going to go out, really whether I make a sale or not. And then bottom line is my net. My net profit could be net loss. At the end of that time period, this is what, the net result is. And I want to make those projections on a monthly basis for 2 years. So 24 months, what are the sales each month? Cost of goods, down to the net sales. And really that gives a picture of, particularly if you're in a seasonal business, it's what happens, the trends that go up and down, which more adequately reflects that you understand how the business works. What are the trends within the time period, as opposed to taking a number and dividing it by 12. Which may or may not be an adequate reflection of how sales happen within your business. The next important piece of financial data that will be included in your business plan are cash flow projections. And this is different from the profit and loss statement because the cash flow statement or projections are really, it's just a budget, a forward-looking budget. And it really reflects timing of the cash. Whereas your P&L, your profit and loss statement, reflects sales and expenses, it might not necessarily reflect when the cash comes in your business and when the cash leaves your business. So that's what's captured on the cash flow projections. So I have a beginning cash amount of money that I'm starting with, plus whatever cash that comes in during that time period. And that could be sales revenue, Could also be loan proceeds, could be owner investment, could be sale of assets, any number of sources of cash that would come in during that time period. And so, adding that to what I start with, I've got total cash available. And then I have cash out during that time period. This could be those one-time expenses if it's a startup period, whatever it takes to buy my equipment, my inventory, things like that. And then also is my operating expenses, those fixed expenses that I'm going to pay out, whether I make a sale or not. So all of that money is going to go out during that time period. And if I take my total cash available less total cash out, then that gives me what's left over, my ending cash balance. And we're going to do this cash flow projection, much like the P&L, is monthly for 24 months. And so that ending cash for month 1 then becomes the beginning cash for month 2. And I go through the same process. And I really want to demonstrate to the bank that at the very least, ending cash is not negative, because not a very realistic situation. So I want to show that I've got cash when I need it. I can repay the loan and all of my other financial obligations. In developing a business plan and changes in your assumptions, I can look at, if I'm ending up with a negative balance, what do I need to do? Can I, increase sales realistically? Can I lower cost of goods? And that would help you evaluate the change in that, what would happen to the ending cash at that point. The next piece of financial data included in your business plan is a balance sheet. And a balance sheet reflects what you own and what you owe. Also, you might look at it, if I look at the two sides of the balance sheet, assets, are the things that I own, and the liabilities and owner's equity, how I paid for it. So assets broken down typically into two categories. Current assets are those things that have about a short-term value. They could be liquidated within a year's time. So cash, accounts receivables, inventory to some extent, those are what would be referred to as current assets. I could turn those into cash relatively quickly. And those long-term assets are, building, capital equipment. It would take longer to turn them into cash if I needed them. So the asset side of the balance sheet demonstrates what you own, and then we look at how you paid for it on the other side. So liabilities could be, for instance, I have accounts payable. So I have some suppliers perhaps that give me terms, 60 days, 90 days to pay for something. That's a way of financing, a method of financing through my suppliers. I might also have borrowed money, perhaps a small business loan or from an individual. And so that's a liability, something that's going to have to be paid back. But I use that to acquire assets. So for liabilities, we also look at current and long-term. Current liabilities, those things that need to be repaid in less than a year. So your accounts payable, again, if you're given 60 or 90-day terms, that would be something you would have to pay back within less than a year. If I have short-term borrowing, perhaps I have a line of credit that I draw down and I pay back. Another example of a short-term or current liability. And then I have long-term liabilities, and that may be, for instance, if I get an SBA loan, that's got a 5-year term, then that would show up as a long-term liability. I have a longer period of time to repay that debt. Owner's equity is another way you finance assets for a business. So this reflects your investment in the business or somebody else's investment in the business, not loan proceeds, but invested dollars that are there for the growth of the business. And as time goes by and you have profits and losses, then you're going to create another item on the balance sheet under owner's equity called retained earnings. And retained earnings captures, really what you've been able to generate through the operations of the business. So if I have a profit, it's going to add to that owner's equity piece. If I have a loss, it's going to subtract from the equity piece. And so it still keeps the balance sheet in balance. So if I have a profit, then on the asset side, it's going to be reflected perhaps as cash. If is the loss, then it might reduce cash. So the balance sheet is reflecting, what position at any given time the business is in. And this is a really important financial statement for a lender because it gives an idea of how much debt you have compared to how much you have invested in the business. So a really critical financial statement. And this is typically not done on a monthly basis, but the bank would want to see an initial balance sheet. So based on the sources and uses of funds, what am I going to buy with the money? How am I going to spend the money that I need for starting the business? The balance sheet is not something that you'd really do on a monthly basis. What a bank would expect is first an initial balance sheet that reflects, based on the sources and uses of funds, how are you going to spend the money and what assets will you own based on the money that you've borrowed and or invested. And then they want to see a balance sheet at the end of each successive year. Let's just say probably 3 years is a good time period. So at the end of the year, what does the balance sheet look like? How have profits added to the equity piece? What kind of assets have you purchased? Have you borrowed more money? Gives an overall financial picture of the business at any one point in time. So that's a list of the important financial data that needs to be included in your business plan. And even more important maybe than the documents themselves are the assumptions behind the numbers that are included in those financial statements. How did you derive those numbers? What information did you use? So your sources of market research information, your demonstration that you understand how money flows in and out of the business. Those are all critical pieces. So you don't want the banker to wonder, where did that number come from? You really want to document those assumptions so that they don't have any question about the validity, the credibility of the numbers that you've included in your projections. Now you have the information you need to know when preparing your loan proposal, all the information that a bank is looking for to know how much money you need, what are you going to do with it, and most importantly, how are you going to pay it back.